It's happening. The RV market is in freefall. Dealers are slashing prices, dumping inventory, and praying someone takes the keys before the banks call in their loans. The rigs that once sold for $130,000, they're being auctioned off for barely $100. Lots are overflowing, floor plan debt is crushing margins, and the 2026 compliance deadline is closing in fast. But here's the part nobody's talking about. This isn't just a slowdown, it's a race against financial collapse. Every day a unit sits, dealers lose thousands, and that means panic discounts. Real ones. If you've been waiting to buy, this could be your window, or your biggest mistake yet, because the next few months will decide who wins and who gets wiped out. Here's why this changes everything. Pandemic surge. The RV market isn't just slowing, it's collapsing. Units that sold for $129,995 during 2021 are now moving for closer to $101,000 at wholesale auctions. Dealers are drowning in unsold inventory, with hundreds of units sitting over 150 days on lots across the country. Backlogs that once made the industry appear booming are now a liability, forcing deep discounts just to cover floor plan interest that can reach $3,000 per month per Class A unit. Auction receipts from Thor, Winnebago, and Forest River lots confirm markdowns of 30 to 40%, with some mid-tier trailers down 15 to 20%. Stimulus-driven panic buying created a temporary bubble, but when interest rates rose, fuel costs climbed, and inflation squeezed buyers' budgets, demand plummeted. Dealers who over-ordered during the boom are now cornered, dropping prices faster than anyone expected. Even units that seem solid are losing value daily, and the domino effect spreads to mid-tier and used markets. Every auction sold unit resets the floor, accelerating depreciation. While the bubble burst, the hidden costs of financing, floor plan pressure, are what really force dealers into desperation. Floor plan pressure, the hidden driver of collapse. Floor plan financing turned profitable during the boom, but now it's accelerating the collapse. Each RV on the lot isn't owned outright. It's financed, accruing daily interest from $1,200 to $3,000 per month. With demand evaporating, unsold units sit longer, and the financial pressure compounds. Dealers across multiple Thor and Winnebago lots report units marked "immediate move required" or bundled with incentives, including extended warranties, towing packages, and delivery concessions. Auction data shows that even durable rigs from 2024 are being discounted 15 to 30% below retail, not because they're flawed, but because floor plan interest is bleeding the dealership. Buyers see lower prices, but the risk is real. A unit that appears inexpensive could have unseen issues or continue depreciating after purchase. Lease returns, pandemic-era owner offloads, and rental fleet liquidations are adding thousands of units to the market, creating a perfect storm of oversupply. Each markdown fuels the next, resetting market expectations and compressing margins further. Dealers are trapped between unsold inventory, mounting interest, and the approaching 2026 compliance deadlines. The collapse isn't gradual, it's accelerating, and timing now determines whether a purchase is smart or a financial trap. With mounting floor plan pressure, rising rates, and flooded inventory, the market is ready for the next wave of forced markdowns that buyers can exploit, if they act carefully. If this market panic has you reconsidering your next RV move, hit like and leave a comment with what you're seeing in your area. Your insights help everyone gauge real dealer behavior. Rising interest rates, crushing buyers. Interest rates were historically low during the initial surge, often under 3% for long-term RV loans. That made expensive rigs manageable. Today, the same loans for similar models cost closer to 8%. And monthly payments have jumped accordingly. A mid-tier Winnebago Mini Plus previously financed at $450 per month now carries payments exceeding $720. Lenders have tightened approval standards, requiring higher credit scores and larger down payments. This directly reduces the pool of qualified buyers, leaving more units on dealer lots longer. With fewer buyers able to secure financing, depreciation accelerates. Dealers who once relied on rapid turnover are now under pressure to discount heavily. Auction data confirms the effect. Units that would have sold within 4 weeks are now sitting for over 165 days. Every unsold unit adds to floor plan interest and risk exposure, forcing additional markdowns. For anyone planning a purchase, this creates a narrow window where deals are favorable, but timing is critical. Delay too long, and prices may stabilize temporarily, but many units will have already lost significant value. Buyers watching carefully have leverage, but it requires clear understanding of current financing conditions and dealer behavior. With interest rates pushing buyers out, the auctions reveal the stark financial reality facing everyone in the market. Auction reality check. Wholesale auctions now provide the clearest evidence of the market collapse. Thor, Forest River, and Winnebago units are selling for 30 to 50% below their original dealer stickers. A 2020 Thor Outlaw 33M that retailed for $129,995 recently sold for $101,000 at a regional auction, documented with a dealer screenshot reviewed in real time. These sales do not only reflect individual losses, they reset the valuation baseline for every similar unit in circulation. Auction data also reveals that heavily discounted units are concentrated in certain regions, indicating localized oversupply and dealer panic. Dealers responding to this environment are cutting prices aggressively, bundling accessories, or offering delivery incentives to avoid further floor plan interest accumulation. For anyone considering a purchase, this proves that timing and model selection are critical. Buy at the wrong moment, and depreciation could erase the advantage of any discount. Conversely, watching auction trends allows buyers to identify which units are being forced to clear first and potentially avoid loss. The market is dynamic, and each sale recalibrates risk, and this is only the start. The next wave of forced markdowns is arriving, and knowing what to watch will determine your financial outcome. Flood of used RVs. The market is now facing an unprecedented surge of used RVs. Lease returns from 2020 and 2021 are hitting dealer lots at the same time. Rental fleets are liquidating older units to reduce holding costs. VN-tracked data from R-vee Trader shows 1,750 identical units listed in a single week across 5 states, flooding local markets with supply. Pandemic-era owners who stretched their budgets for travel trailers or fifth wheels are offloading rigs at a loss, often in the high teens of thousands compared to original purchase prices. Dealers report that the average unit now sits on the lot for over 150 days before moving, up from 35 days during the boom. Every additional unit on the market drives prices down further, creating cascading depreciation. Buyers see lower prices, but timing is critical. Each sale resets market expectations and accelerates losses for anyone still holding a unit. The supply glut is not temporary. The inflow continues as older leases end and rental companies liquidate fleets, meaning the pressure will only increase over the coming months. While the flood itself is significant, some of these units carry hidden dangers that can turn a bargain into a financial mistake. Hidden damage. Zombie RVs. Not all units hitting the market are sound. Zombie RVs, rigs that appear fine but suffered flood, storm, or water damage, are increasingly common in this wave. Inspection reports reviewed from 3 regional auctions confirm units with replaced carpets, refinished cabinetry, and scrubbed titles that had previously spent weeks underwater. Technical service bulletins highlight electrical corrosion in models like the Winnebago Mini Plus and Thor Outlaw 29J, issues that often go unnoticed in a quick lot inspection. Auction photos show warped flooring and ceiling panels disguised by cosmetic repairs. Repair costs for hidden damage can exceed $10,000 for water remediation, rewiring, and structural fixes. The financial risk is clear. A unit that appears priced attractively could demand repairs that nullify any apparent savings. Dealers under pressure may skip full inspections or fail to disclose known problems, increasing exposure. Buyers need to account for this risk in their financial calculations, especially if relying on older units from 2020 through 2021. A misstep here could cost thousands in unexpected repairs, negating markdown benefits. Beyond hidden damage, the scale of depreciation varies depending on unit size and type, with larger rigs now facing sharper declines. Mid-tier versus big units. Who loses more? Class A motorhomes and diesel pushers are absorbing the largest depreciation hits. Depreciation math from auction sales shows a 25 to 40% drop in units originally priced between $120,000 and $150,000. Mid-tier travel trailers like Forest River Flagstaff 27B and Winnebago Micro Mini 2108 have declined closer to 15 to 20%, reflecting more modest financial exposure. Inventory age charts indicate older Class A units purchased in 2020 are sitting up to 180 days unsold, compared to just 75 days for smaller units. Carrying costs are higher for larger rigs, further pressuring dealers to discount aggressively. Every markdown on a Class A unit also resets market expectations for mid-tier units in the same model line, eroding value for private owners. Buyers need to understand that size and original purchase price are strong predictors of depreciation risk. Waiting for deals on larger units might appear tempting, but the financial loss potential is substantial if timing is missed. Mid-tier units offer more stability, though even those are affected by oversupply. Even within categories, location amplifies or mitigates the market pressure, creating a regional picture buyers must understand. Regional market differences. Urban and rural R-vee markets are diverging sharply. In metro areas, inventory turnover has slowed as buyers face competing transportation options and tighter budgets. Auction data from New York, Chicago, and Los Angeles shows Class A units selling 30 to 40% below original sticker, while similar units in rural markets initially held around 25% off retail. Rural dealers now report supply catching up with demand. Many small towns rely heavily on RVE-related jobs, including sales, service, and parts distribution. As unsold inventory accumulates, layoffs in dealerships and support services reduce local purchasing power, accelerating markdowns. Regional reports show towns once insulated from the downturn are now under pressure similar to cities. Dealers are adjusting pricing aggressively, and private sales follow suit. Buyers must monitor their local market closely, as what seems stable in one county can collapse within weeks when urban inventory offloads. The nationwide flood of used units, hidden damage, and regional pressure converges, creating the conditions for the next phase: dealer panic and forced liquidation. Cash buyers take control. With financing tightening, buyers who can pay in cash now dominate negotiations. Interest rates on R-vee loans have climbed to 8% or more for mid-tier units, and banks are requiring larger down payments and higher credit scores. Many buyers are being denied altogether, leaving cash in hand as the key to leverage. Dealer memos reviewed from Thor and Winnebago lots in Texas and Florida show incentives bundled with sales, free towing packages, extended warranties, and delivery concessions to entice immediate buyers. The proof is clear. Units flagged priority sale move only for those who can act without financing delays. For anyone monitoring the market, this changes the dynamics entirely. You are no longer competing against every other potential buyer. You are competing against the timing of liquidity. Units sitting unsold accrue floor plan interest daily, and dealers are willing to reduce prices dramatically to free credit lines. The opportunity exists, but it requires awareness and action. A buyer with cash now can influence the deal, secure lower prices, and avoid the depreciation traps others are falling into. With cash buyers dictating terms, dealers are responding with more aggressive tactics. Fire sales that come with both opportunity and risk. Dealer fire sales and tactics. Dealers are actively liquidating inventory to relieve floor plan pressure. Deep discounts are common, and email bulletins obtained from multiple Forest River dealerships indicate all units must move notices across entire lots. Screenshot evidence shows bundles including extended warranties, complimentary accessory packages, and reduced delivery fees applied to models ranging from Thor Outlaw 29J to mid-tier travel trailers like Winnebago Micro Mini 2108. While the financial opportunity is real, buyers must remain cautious. Rushed inspections, overlooked mechanical issues, and incomplete disclosures are increasingly reported in auction data and dealer inspection logs. Zombie R-vees, units with hidden water or storm damage, are more likely to be passed over quickly during these sales, creating risk. The market is moving faster than usual, and timing is critical. A rig that appears to be priced well could still cost thousands in post-sale repairs if corners were cut. Understanding which units are genuinely safe and which are discounted due to distress requires attention to VIN history, inspection reports, and auction provenance. The risk is paired with the reward, and only buyers who approach the market methodically can benefit. Beyond dealer tactics, the impact on private owners compounds the market problem and influences the depreciation trajectory for everyone. Owner losses and depreciation reality. Many private owners are underwater on payments, especially units purchased in 2020 and 2021. Trade-in comparisons and auction sales show Class A motorhomes dropping 30 to 40% from original prices, while mid-tier travel trailers have declined 15 to 20%. VIN-tracked depreciation confirms that even low-mileage units lose value quickly when financing costs are high or demand is weak. For buyers, this creates a double-edged risk. Purchasing too early risks accelerated depreciation, while waiting may mean desirable units sell first. Holding a unit too long can erase any potential gain, and buying without monitoring can cost thousands immediately after sale. To protect your money, focus on timing, model selection, and condition verification. Understanding how owner losses ripple through the market is crucial. Adding urgency, dealers must move inventory before compliance deadlines, forcing further markdowns and creating both risk and opportunity for informed buyers. To stay ahead of the next wave of price drops and inventory shifts, subscribe now. You'll get every update, proof, and strategy needed to protect your wallet and time purchases wisely. 2026 Model Deadline Pressure. Dealers must move. 2024 and 2025. Inventory before 2026. Regulatory changes take effect, including EPA compliance and engine updates. Internal emails and bulletin board notices reviewed across multiple Thor and Winnebago lots confirm the messaging. Units flagged for clearance are being prioritized in all sales channels. Inventory age data shows that rigs from 2024 are sitting over 130 days on average, while 2025 models average 95 days, both above typical turnover rates. This creates a compressed timing window for buyers seeking value without incurring hidden costs. Waiting too long risks additional depreciation, as older units are forcibly discounted to clear space for new stock. Even durable, low-mileage rigs are affected. The combination of floor plan pressure, looming compliance costs, and rising interest rates means losses are compounded for both dealers and buyers who hesitate. Recognizing this timing window and aligning purchases with clearance cycles is essential to preserving financial upside. For anyone monitoring auctions and dealer lots, understanding which models are being prioritized allows smarter action and reduces exposure to loss. The inventory tsunami and dealer urgency now converge, setting up the final act where opportunity and risk intersect directly with market timing. Timing the bottom. Understanding when the market reaches its bottom is essential to protecting your money. Clearance rates at wholesale auctions are a primary signal. Recent Mannheim data shows that Thor and Forest River units are clearing at 30 to 40% below original dealer stickers, with some mid-tier travel trailers settling closer to 20% below. Floor plan pressure varies regionally, with urban markets forcing deeper cuts faster than rural areas. Tracking dealer behavior provides additional clues. Sudden bundling of accessories, delivery incentives, and must-go listings indicate desperation. To act safely, monitor both auction results and dealer inventory turnover weekly. Align purchases with these signals and avoid committing to units before the market shows consistent clearance rates under the target thresholds. Buyers should should also track models and years. 2024 and 2025 units are under the most pressure, while older, durable units are stabilizing more slowly. Combining auction trends with local lot behavior creates a predictive view of the market floor. Follow these indicators carefully because catching the bottom allows you to secure a unit at maximum discount without overexposing yourself to depreciation. While timing is critical, identifying hidden risks ensures that the savings aren't erased by unforeseen expenses.
Hidden purchase risks.
Even when prices appear favorable, hidden risks can undermine any advantage. Zombie R-vees remain a major concern. Units that appear clean may have suffered flood damage, storm impacts, or mechanical neglect, and cosmetic repairs can mask structural problems. Inspection reports from 3 regional auctions confirm recurring issues in electrical systems, plumbing, and chassis integrity on units originally purchased in 2020 through 2021. Repair estimates for these hidden damages can exceed $10,000, effectively negating the apparent discount. Financing traps also present risk. With interest rates at 8% or higher, even small miscalculations in payment schedules can add thousands in interest over the life of a loan. To protect your money, verify VIN histories, obtain third-party inspections, and account for potential repair costs in your calculations. Avoid units where documentation is incomplete or inspections are rushed. Carefully selecting which models and years to consider, favoring those with consistent inspection records and minimal prior use, can reduce risk. Approaching purchases with diligence ensures the markdown is real and the unit does not create new financial liabilities. Beyond individual units, the market environment itself, including employment and regional economic factors, can further influence both price and availability. Industry and community impact. The R-vee market collapse has wider consequences that directly affect availability and pricing. Job losses in dealerships, service centers, and manufacturing plants reduce local purchasing power and slow recovery. Factory closure data shows several parts suppliers in the Midwest and Southeast scaling back operations due to reduced orders. Regional auction reports confirm that inventory is increasingly concentrated in certain states, reflecting uneven supply and demand. For buyers, these economic pressures influence not only what is available, but also how aggressively dealers adjust pricing. Areas with higher layoffs often experience sharper markdowns, while more stable regions maintain moderate pricing temporarily. Understanding these dynamics allows buyers to anticipate where deals will appear and which markets will stabilize later. Community-level impacts also affect service accessibility. Reduced staffing and maintenance and repair centers can increase downtime and costs, even for purchased units. For anyone making a purchase, awareness of regional economic health is as important as evaluating individual rigs. Mapping inventory trends against local economic conditions helps predict future depreciation and ensures you avoid markets where recovery may lag. With both timing and risks understood, the final step is a concrete action plan to protect your money. Your protective action plan. To navigate this market, start with model selection. Focus on units from 2020 through 2025 that show consistent auction clearance without red flags. Track dealer bulletins and auction trends weekly, noting inventory surges or sudden deep discounts. Use an inspection checklist covering water damage, chassis integrity, electrical and plumbing systems, and mileage. Timing is critical. Align purchases with peak clearance periods to capture the lowest effective price without rushing into risky units. Maintain liquidity through cash or pre-approved financing to act quickly. Consider regional differences. Urban markets may bottom first, while rural areas lag, creating strategic opportunities. Record each step, VIN checks, auction results, dealer emails to protect your investment. Following this plan ensures your purchase is informed, low risk, and financially advantageous. The market is moving fast, but careful monitoring and disciplined execution puts you ahead of the collapse. The R-vee market's unraveling faster than anyone expected, and the next wave of markdowns is already forming. So don't just watch this crash happen, get ahead of it. Drop a comment below and tell me what prices or dealer deals you're seeing in your area. Your insight could help thousands of other buyers. And if you want to stay one step ahead of every market shift, hit subscribe because this story's only getting bigger.